us taking that conversation right from there to look at the marketplace and read a bit of analysis on that. Let's bring in Omotola Abimbola, who is one of the investment analysts at Afrinvest, to the conversation this morning, starting bringing the economic data we're looking at, and then the equities that's been a little bit weak at the knees, and the yields that are tumbling. Good morning.
Good morning, Boston.
Good to have you here. Start the week for us on what we'll get to Kemi Adeosun's, the finance minister's tweet a little bit later. But if we look at the top economic stories that you think will drive the second half of this month forward.
Yeah, there are a couple of data coming out this month. We already saw capital importation for Q1 coming out last week, and in line with expectation, we saw a rise in foreign inflows into the Nigerian economy, although it was wholly driven by foreign portfolio investments, both on a year-on-year basis and on a quarter-on-quarter basis. For us, we still believe that the weaknesses we are seeing in foreign direct investments is a missed opportunity in capitalizing on the current positive macroeconomic backdrop to increase the stock of foreign capital in the Nigerian economy, to encourage capital formation and create more jobs for the economy. But regarding the other data coming out later in the month, we are expecting April 2018 CPI numbers to come out later this week, and we are forecasting a moderation in inflation from 13.3% to 12.6%.
That's at Afrinvest?
At Afrinvest. And that will mark the 15th consecutive moderation in headline inflation.
For you folks? What do you think will drive
it will be two. Number one is the high base effects. I think from the points when inflation peaks at 18.7% in January 2017 till now, high base effect has been the major driver of the deceleration in inflation, and we expect that to continue, particularly in both the food and the core index. The second factor that probably drives it is what we are calling the relative stability in food prices in the planting season of 2018 compared to the same period of last year. Last year during the planting season, we saw a significant spike in food prices, driven by two major factors. Number one, we were seeing increased exportation of Nigerian grains to neighboring countries, particularly in Niger and Chad. And we also saw a relatively weaker production as well. But the last harvest season was very bountiful for the economy, as we can see from the Q4 2017 crop production GDP data. So due to that, we are seeing much more subtle volatility in food prices at the end of the harvest season. So those two factors should combine.
Some folks say tomato prices are increasing.
That's a season.
And I saw that on Twitter this morning, tomato. I'm sure that's a conversation.
Yeah, I'm speaking relatively now. We are comparing the current planting season to the same period of last year. But what we also expect to see is that when the CPI numbers come out, we expect to see a subtle increase in month-on-month inflation driven by seasonality. We must recognize the fact that we are at the end of the harvest season already, and in the planting season we usually see volatility in food prices typically.
Okay, well, that's okay. That's taken as given.
And beyond the CPI numbers as well, I think next week we are expecting Q1 GDP data to come out for the economy.
Anyone has an outlook on that? I haven't heard from any of you folks about what the Q1 GDP is likely going to look like.
We actually have one. We think growth would expand to 2.68% in Q1 2018.
Year-on-year numbers.
Year-on-year numbers, and we expect that improvement in growth to be driven by both the oil sector and the non-oil sector. For the oil sector, it's going to be majorly a base effect thing because last year, Q1 2017, oil production numbers were still below their peak level. And since the resolution of the Niger Delta crisis, we have seen significant improvements in oil production numbers coming out of the Niger Delta region. So currently we are forecasting oil production to be at around 2.1 million barrels per day in Q1. And if you compare that to around 1.8 million barrels per day that we had in Q1 2017, that should lead to approximately around 15% year-on-year expansion in oil sector GDP. For the non-oil sector, we saw a broad-based improvement in non-oil sector growth in Q4 2017, and we expect that to continue in Q1 2018. It will be driven partly by trade sector because in Nigeria, typically, when you have foreign exchange shortages, it really has an impact on the trade sector because it is highly FX dependent. But since we have been able to achieve stability in both liquidity in the FX markets and also stability in terms of the rate as well, we have seen trade numbers go up, and even the customs agency are recording improvements in their income generation from trade activities. So we expect trade to rebound substantially in Q1 2018, as well as the high city sector, telecoms. MTN number reported their group numbers earlier, I think last week or 2 weeks ago, and one of the high points from the data they reported is that there was a net addition in subscriber numbers in Q1 2018. So that should also have an impact on the aggregate GDP numbers for the ICT sector of Nigeria as well.
So let's put all of that in on market straight and start with equities. If the macroeconomic numbers look a little bit good, then why is the stock market getting buffeted almost on a daily basis? You're not really sure whether it's a very strong tailwind or a strong headwind. It looks like it's just moving this way. You're not sure where the market is really heading.
Yeah, to be sure, we have some tailwind factors which should normally be driving the equity markets, in the positive direction. Essentially, the improvements in macro fundamentals. We also have some headwinds that we are facing as an economy, and I think the major one that most investors are pointing out to is the political environment as we approach the election season. So if you study the capital allocation data for Q1 that came out last week, there was a decline, a quarter-on-quarter decline in foreign portfolio investments into equities. So we saw more of the foreign investors reducing their exposure to equities and going towards debt instruments. So that recalibration of risk would likely be a drag on equity market sentiment in the near term.
You think investors are getting a little bit jittery? I'm not a little bit concerned about this. What's some folks getting missing, whatever, who's doing what at the political arena? Indeed,
because politics is a major driver of performance in emerging markets, particularly frontier markets such as ours. If you go even outside of Nigeria, if you go to the Asian region and even other SSA frontier markets, typically during electoral cycles, we see volatility in their markets. So most investors try to anticipate this, and they try to reduce their exposure towards the risk assets towards the election season.
Also, let's spend about 1 minute or so to digest the Kemi Adeosun's tweets on falling the yield curve. Are you happy with that? We spent about 1.5 trillion in 2017 budget on capex, but again, the yield, she's correct, is tumbling, and that's good news for the government.
It is good news for the government, and it is good news for the private sector. For the government, the declining yield in the fixed income space, it's going to have an impact on their debt servicing costs, and that is a major consideration for most rating agencies in assessing Nigeria's credit status. If you look at if you study the rating agency action by S&P and Fitch in the last 2 years, one key point they've been highlighting every year is that our debt servicing ratio to revenue has been so high. So with the declining yield environment on government securities, it's going to have a positive knock-on impact on debt servicing costs. And then for the private sector as well, it has unlocked a world of opportunities for more access to the debt capital markets, because the government is no longer crowding out the private sector as they used to before. And if you, looking at reports coming out from the private sector over the last couple of weeks, there have been increased appetites for local corporates to seek corporate debts in the fixed income markets in 2018.
Yeah, that's how things look like. As we speak now, Bloomberg is reporting that even our neighbors, Ghana, is looking at doing something with their interest rate as well after they did $2 billion Eurobond last week.
Correct.
And they want to look at what Nigeria is doing. As it's time to bring the domestic borrowing costs down a little bit further. Let's expand these conversations in the days ahead. Thank you very much for your time. And
pleasure.
Thanks for kicking off the trading week for us here on Business Morning. Omotola Abimbola from Afrinvest, one of the investment analyst team. We'll go back. If you missed that a little bit of the currency Naira Jones swap conversation on Friday, we'll bring a bit of that back for you after the break.